I want us to go direct to this question. Number 1B, the 𝒓𝒐𝒕𝒆 Limited. Number 1B, question number 1B, question number 1B. Question number 1B. This concept of portfolio catalogs financial management, advanced financial management. Right. So the question reads, 𝒓𝒐𝒕𝒆 Limited is contemplating building a three asset portfolio comprising assets of firms A, B, and C. The company wishes to invest 5 million shares in the shares of these firms. The shares of these firms. Given below are the number of shares and the current market prices per share for each company. We've been given company ABC, number of shares 50,000, 32,500, 40,000. Then we have the current market price per share. We have the current market price per share. Sound is okay. Is the sound okay? Yes, you have to check. Check from your end, Max. Check from your end. The sound is very okay, unless somebody else tell Walimu that it is not okay. It is not. Oh, people are not able to hear Walimu. Variation. Oh, it's not. A lot of records. Okay. A lot of records. Yeah, for the echoes, you're going to allow Walimu because we are in a new studio here. We are in a new studio, and this studio is having echo. I agree with you, but please confirm that you can at least hear Walimu. Before I continue, please confirm that you can at least hear Walimu. Confirm that you can at least hear Walimu. Confirm that you can at least hear Walimu. Okay, very audible. Okay, sawa. Thank you so much. So I will share the question again, and Raura, can I appoint you to be sharing this question, because I don't want to keep on sharing this question. Raura, kindly pick that job. Be sharing the question as the student keep on joining. So that I don't keep on looking at that. Good. Now let's continue. So I'm leaving question number 1B. And it's about portfolio theory. And portfolio theory, as I said, it catalogs financial management and advanced financial management. Good. So 𝒓𝒐𝒕𝒆 Limited is contemplating building a three-asset portfolio comprising assets of firms A, B, and C. The company wishes to invest 5 million shares in the shares of these firms. Given below are the number of shares and the current market prices per share for each company. A, B, and C. Somebody to respond to those people who are hearing the echo. Somebody just respond to them. Somebody respond to them. Kindly. Number of shares 50,000. That's 2,500. 40,000. And then we have the current market price of a share 50, 40, and 30. The forecasted market price for each share after 1 year and the probability of occurrence in different state of nature is given below. So we have boom, no more recession. Boom, no more recession. So probability 0.3, 0.4, 0.3. Then we have the forecasted share price after 1 year. We have for company A, B, and C. Thank you for those people who are responding. Thank you so much. A, we have 60, 55, 48. B, we have 50, 46, 35. And then we have C, 36, 34, and 27. And 27. All right. The correlation coefficient of the returns of the assets are given as follows. So we have A and B. which is 0.98. Then we have A and C, which is 0.76. And we have B and C, which is positive 1. That is correlation coefficient. Correlation coefficient. And I would like to remind you something here. If we talk about correlation, correlation coefficient, we get this by looking at the covariance of asset A, B, divided by the standard deviation of A multiplied by standard deviation of B. That is how we get the correlation. Correlation coefficient, this is the formula of getting correlation coefficient. So this examiner has given us what? The correlation coefficient. We're going to use that information as we tackle the question. So what are we required to do? We require to come up with the expected portfolio return. Number two, using the mathematical model, compute the portfolio risk. Now, at this point, we have to think of what is this expected portfolio return, or expected return of the portfolio. We have three securities for the company. So we want to get the weight of A. We have to get the expected return of A multiply plus weight of B, expected return of B, like that, plus weight of C, and then we multiply by expected return of C. So that is the formula of getting the expected return of a portfolio. Remember, this is different from expected return. So we shall be able to compute the expected return of each portfolio. Now, what have we been given by this examiner? I can see the examiner has given us some items here. We have in each condition we have been given the prices or the market value, What we need to do is to get the return of each condition or each security. So we can start with the first one. Let's start with the first one. We have A. We have company A. I know I cannot proceed without returns. So company A, in my case here, I have to check what I have in my question. I have been told that the current market prices per share is 50, 30, and 40. Capacity is full. Some people can't join. Now. We don't have anything to do, kindly. We don't have anything to do on the same, because just accepting 100. Kindly. What we have to do is to check where we have table 2. We've been told that A, the forecasted share price for after 1 year is 60 for boom, 55 and 48. And then we have the price, the current market price per share. We need to get what is the change, what is our return. So we have to pick the items that we have. I have for boom I have 60. Minus 50 divided by 50. That will give me the returns for A. Return for A as a percentage. For the second one, this is for boom. For the next condition, no more. I have. What is the price? What is the forecasted share price? What is the forecasted share price? For A. 55. Thank you. 55. So I have 55 minus 50 divided by 50. Get something. And then the other one is for recession. Recession in this case, what is the forecasted? 48. So I'll be having 48 minus 50 divided by 50. So that I get the returns. After getting the returns, I'll be able to work on this. So can you give me very fast the returns for this A, the term for security A under the first condition, which is boom. Kindly give me this. Give me this. Give me this. 2, 0.2, so 0.2, which is the same as 20%. 20. So because I have a percentage here, I can have it as 20. 20 like that. Give me the second one. Very fast, give me the second one. Kindly give me the second one. 55 minus 55 by 50. 0.1, which is 10. What about the other one? The other one? I want us to move to the next one. I want us to move to the next one. Give me this one. 48 minus 50 divided by 50. Of course, it will be a negative. Choose to use 50. Why do you choose to use 50? Negative 0.04. So that is right. Negative 4, negative 4, negative 4, negative 4, negative 4, negative 4, negative 4. So we have the percentage here. So when we deal with the company A, these are the returns that we are going to use. And now we can move. We can move. Somebody to share the question. Somebody to share the question. We can move to B, company B, company B, company B, company B. I have boom, and the expected, the forecasted, I have an amount of 50 here. I have an amount of 50 minus, what is my current? What is my current price? 40. You look at the table 1. B is going with 40. 40. So we have to share, we have to minus 40. Table 1. We have table 1. Table 1. And then table 2. Divide by 40. That is the return we are going to get there. Return in percentage. That is the first one. Then we have normal. We have normal at this point. Normal. What is our forecasted price for normal? Forecasted price for normal. Forecasted price for normal. 40 will be repeated. It is 46 minus 40 divided by 40. Divided by 40. Of course, if you multiply by 100, you're going to get it as a percentage. A percentage. Done as a percentage. And then we go to the other condition, which is recession. Recession. What is the forecasted price? Forecasted price. I have to check my. Okay. Now the account that we are using, 𝒕𝒂𝒓𝒕 unless 𝒕𝒂𝒓𝒕 unless what will happen? If I can change, but now the link has gone to very many goods. What will happen? So 35 minus 40 over 35 minus 40 divided by 40 divided by 40. So can you give me this? You can place it as a percentage. Ni sawa. Haya, nipatie hapa. Give me this. This should be 50 minus 40 divided by 40. I have to check this. 25. 25 hapa. What about this one? 46 minus 40, 50. 50. Naiweka hivyo. And then the last one. Negative 12.5. Thank you. Negative 12.5. Having done that, we go to C. Company C, security C. It's other two. Company C or security C. Now at this point, allow me to pick this for a minute. So after doing that, sorry for that. C, company C, what is the forecasted price for C? In fact, for our boom, 30. So if it's 30, and then you check Forecasted, forecasted you have to check. Was it really 30? Hapana, watu wamesahau. That is the current. That's the current. The current is 30. Forecasted was 36. 36, yes. So I have 36 minus 30 divided by 30. Oh, I'm being told that these people want to join. Yeah. Let's see what will happen. Now these calls. These are returns. Like that. I have my normal, and we can say that we just give the percentage. And don't worry, under this topic, if you put your answer the way we are putting, you're going to get your mark. It's not a must you put the percentage. Then we have the other one, which is the recession like that. Give me the forecasted, yeah? Forecasted for normal. 34, we share the paper, minus 30, divided by 30. And then we have recession. 27 minus 30, divided by 30. We shall be able to get the first one. If you know how much is this? When you left this one, 36 minus 30 divided by 30, 20. Yes, 20. 34 minus 30 divided by 30. How much? Yeah, 13.33. Done. The other one, 10. 10 minus 10. Done. After doing that, you check what the examiner wants you to get. Examiner wants us to get the expected portfolio return. And in our mind here, we have put our formula here that we need weight of A, expected return. So I don't have the expected return. How can I get expected return? Expected return is given by summation of return times probability. And now we have our return. If I talk about A, these are my return. I'm going to use this. If I talk of B, these are my return. So let's get the expected return of each security. Let's start with the expected return of A. So I'll be happy. Return and probability. And I've told you, don't even put a percentage here. Pick it the way it is. 20, 10, -4. So you have 20 times. What is the probability for the first one? Just check for the first one. For A. Of course, the probability is common. Is our probability common? Yes. We're dealing with a common probability. 0.3. Because it's summation, we add our next one, which is 10 times. What is the probability for the next one? The second one? Probability. To remove this one. I'll be happy 0.4 plus the other one, which is -4. If it's a negative, you need to move with that negative. And then you get your final answer. Give me the final. You know probability must add up to 1. That's why just put 8.8 done. 8.8 done. Let's go to the next one for B. B items are here. These one and those two. So I'll be happy. Expected return for B. For B, I have 25 times 0.3 plus I have 15. I'm just making that times 0.4, and then I have the last one, which is negative 12.5 times 0.3 times 0.3. Give me that. 9.75 done. 9.75 done. We go to expected return of C. C items are here. The returns are there. 20 times 0.3 plus 13.33 times 0.4 plus 10, of course, negative times 0.3. How much do you get? But here, somebody to share the paper, somebody is requesting 8.33 like that. Done. Please confirm by typing Y for yes that we are together up to that point. Are we together? typing Y for yes. Just type Y for yes. That you're together at that point. Are we together at that point? Thank you so much. Thank you so much. Thank you so much, Max, for sharing the paper. Asante. Asante. I want us now to move to the next part. Remember, we need to get the weights. We need to get the weights. And for this question, examiner had decided to confuse all the students. Examiner had decided to confuse all the students. You've been given the number of shares. Number of shares of A, number of shares of B, and number of shares of C. Is it possible for us to get the value of share? Is it possible for us to get the value of share? And we are going to use the optimal capital structure. The optimal capital structure. I know that if I have I need value of share is given by number of share times the market value or market price. Market value or market price. 5M time number of shares. Wait. Good. It's okay. Now, number of shares have been given. The first one for A, what is the number of shares for A? Number of shares A plus equal to the one. In 50,000 number of shares. And its market value in ngapi? 30. Is it 30 or 40? It is 50 market value. So 50,000 times 50. Unapata ngapi? 25,000. 25,000. That is the value of A. For B, it will be how much? What is the number of share for B? Number of share for B. 32,500. The market value or the market price at that point, market price in ngapi? Market price in ngapi? 40 and 40. How much are we getting? And then we move to C. 1,300,000. Asante. We move to C. Move to C. Aha. Twende kwa C. 40. C iko na 40,000. Okay, sawa. It's a times 30. If the market value was 30, that gives you the 1200,000. Now the total of this itakuwa ngapi? Total ya hii ndio ile 5 million yetu. Total ya hii kiongeza inakuwa ngapi? Plus total ya hii 5 million yetu. 5 million yetu ile tulikuwa tunadili nayo. So I can get the weight of each by taking the proportion. I take 2,500 divided by 5 million. That will be the weight for A. Weight for B will be 1,300 divided by total. So a proportion of a whole. So the first one will be 2,500,000 of course divided by 5 million. Napata 0.5. Hiyo ni 0.5. Ya pili itakuwa 1,300,000. 1,300 divided by 5 million. Hiyo itapata ngapi? Hiyo itakuwa 0.26. Asante. 0.26. So tunaweza kuwa na two decimal places. And the last one is 1200,000. Wait. 1200,000 divided by 5 million. Divided by 5 million. How much is that? 0.24. Asante. Thank you so much. After doing that, you come and now have your question done. Come and have your question done. I need to get the expected return of a portfolio. So there's a difference between expected return and expected return of a portfolio. There's a difference. For the PP, my weight 0.5 times. We got the expected return for A. Unfortunately, I wrap. Yeah? Expected return for A equal to expected return ya A. Expected 8.8. Plus I think 0.6 times the expected return is here 7.5. And then I have the last one 0.24 times expected return of 8.33. Like that. So what is our expected return of the portfolio? What is the expected return of the portfolio? So tulisema kwamba ukitaka kuweka percentage hapa weka, ukitaka kuiacha hivyo ni sawa. It's okay. You can leave it like that. You can put the percentage, no problem. No problem. Then you can go to Roman number 2. But before then, please confirm that we are together up to that point. Are we together? Are we together up to that point? Are we together? Are we together? All right. Right. Let's go to Roman number 2. Let's go to Roman number 2. Using the mathematical model, compute the portfolio risk. Using the mathematical model, compute the portfolio risk. Now, this is where the bigger formula comes in. This is where the bigger formula comes in. The standard deviation of the portfolio. The standard deviation of the portfolio is the one that they want us to get. And it's given by the bigger formula. The bigger formula. The square root of the weight over A squared, standard deviation of A squared, plus weight over B squared, standard deviation of B squared, plus we have the security, so we have weight over C squared times the standard deviation of C squared plus 2 weight of A, weight of B for variance of A, B. Hapo tutamaliza hiyo ni step, bado tunaendelea. We did. Plus 2 weight of A, weight of C, for variance of AC. Nataka hapo uiangalie vizuri. And then plus tuko ya mwisho sasa 2 weight of B, weight of C, for variance of BE. Now that is the formula. But I want to remind you something. In our question, examiner gave us correlation. And I told you that correlation is given by covariance. Let me use AB. Covariance of AB divided by what? Standard deviation of A multiplied by standard deviation of B. I want us to be together here. If correlation is given by this formula, can we make our covariance the subject of the formula? Is it possible for us to make the covariance the subject of the formula? Is it possible? Because whatever that we've been given is correlation, but our formula has covariance. It has covariance. So to do that, you can just multiply. I say that correlation times standard deviation of A times standard deviation of B is equal to covariance of AB. Having done that, I'm now able to pick. Why not use correlation approach? Cynthia, no problem. In fact, now, after doing this, I'm going to replace where I have the covariance with the correlation, because correlation was already given. I think for AB was 0.98, for AC was 0.76, so that is the approach we're using. We've just converted, or we've just made our covariance now the subject of the formula. So let's now replace, but we don't have standard deviation. So we have to compute standard deviation first. Remember, this is the standard deviation of the portfolio. This is the standard deviation of the portfolio. So let's get the standard deviation of A. To get standard deviation, we say that it's given by the square root of variance. Standard deviation is square root of variance. Purity amesema kwamba yeye anachukua zile 4 za kwanza, alafu nyingine anaignore. Wewe Purity, you never know, it can't be the savior, eh? It can't be the savior. So how we get variance? Variance is given by summation of return minus expected return squared and then times the probability. Times the probability. Times the probability. Now at this point then, I can now input everything inside my square root. I can input everything inside my square root. Remember, what was our return for A? Return that we computed. Return that we computed. Return that we computed ilikuwa ngapi? Ilikuwa ngapi? No. That is expected. That is expected. Returns zile to compute. 20 minus 8.8 squared times the probability was 0.3. Or like that. Plus ya pili, summation. Ya pili ilikuwa ngapi return? Ya A return. We computed 10 minus 8.8 squared times 0.4. Ya mwisho ilikuwa negative something. Was it negative 4? Negative 4. Negative 4 minus 8.8 squared times 0.3. I would like somebody to give me just something to square. Ufanye tu hii yote and then uniambie tu figure yote kishafanya patie something to be square, we get standard deviation of B. Then we move to the next one. Haya tupate hiyo kwanza. 9.34. Now we're patia 9.34. You have to confirm. Am I now putting 9.34 here now? Are we putting 0.3 here? 9.34? 9.34? Okay. Standard deviation. Oh, so what is the amount here? What is the total? Total easy. Yeah, or 87.36. 87.36. So that one is 9.34. That's the standard deviation for A. Move to the next. So let's get the standard deviation of B. Let's get the standard deviation of B. Formula remain. So standard deviation of B will be given by square root of give me the return. Return ilikuwa ngapi hadi? Return sasa tuko kwa B. Somebody who is having the return of B. Return of B ya kwanza. Return of B. Return ya B 25. Minus expected return. Expected return. I don't remember. Was it 9.25? Ilikuwa ngapi? 9.75. 9.75. Time of course squared times 0.3 plus return ya pili ilikuwa ngapi? Return ya pili ilikuwa ngapi? Return ya pili ilikuwa ngapi? Return ya pili 15 minus 9.75 squared times 0.4 plus the last one. Give me the last one. Return ya mwisho ilikuwa negative 12.5. Negative 12.5. Negative 12.5. Negative 12.5 minus 9.75 squared times 0.3. Times 0.3. Open correct. Give me now the figure to square here. Give me the figure to square there. Give me the figure to square there. Give me the figure to square. Give me the figure to square. Itakuwa ngapi? How much? How much? How much? How much? Fine. Just take your time. Take your time. Take your time. Take your time. Take whether there is information. Take your time. 29.3125. 29.3125, and that one translated to copy 15.1. 15.1. Asante, thank you so much. May God bless you. Let's go to the standard deviation of C. Standard deviation of C. What was this? Our return for C. Return for C. He returned 20 minus expected return ilikuwa ngapi? 8.33. I didn't remember. 8.33. Yes, 8.33. 0.33 squared times 0.3 plus return ya pili how much? Return ya pili ilikuwa ngapi? Songa. Return ya pili 13.33. Okay. 13, okay, sawa. 13.33 minus 8.33 squared times 0.4 and then we add return ya mwisho. Return ya mwisho ilikuwa ngapi? Return yenyewe negative 10 minus 8.33 squared times 0.3. So give me something square there. Give me something square. Tuko karibu kumalizia. Tunamalizia sasa. And if times allow, I will also touch on something under money market. Money market tulikusha ile kuingiza mkono kidogo. Mother's model kidogo. Isonga. Let's see what the time we allow us. 151. So this is 151.653. Itakuwa 12.31 done. Now we replace all these. To get the third deviation of the portfolio, we replace all these items here. Weight here A ilikuwa 9. Weight here A was 0.5. 0.5 squared times standard deviation of A 9.34 squared. 4 squared plus weight of B equals 0.26 squared. B 6 squared times standard deviation of B is 15.14 squared plus weight of C it was 0.24 squared times this one 12.31 squared plus sasa hapa ndio tutaleta hii yetu. Leta hii. Unaona hiyo? Correlation of AB times standard deviation of A times standard deviation of B. Hiyo ndio ya kwanza. So tunaangalia vile tumepangiwa correlation zetu pale. Wametuambia correlation coefficient of AB is plus 0.98. So we shall be taking it. If we start with the area, the corner weight of A, I'll be having weight of A, which is 0.5, 2, of course, 2 times weight of A times weight of B. Weight of B is that. Weight of B for it is 0.26, right? Weight of B, 0.26, right? Is that correct? Weight of B, 0.26. Alafu sasa tulete correlation of AB, which is times 0.98. Now, we need to convert it into covariance, so we have to multiply by the standard deviation of A, standard deviation of A, which is 9.34, times standard deviation of B, which is 15.14. Here is step 1, hapo hivyo. Haya, plus hii ingine tunaendelea tukingine pole pole tukiambi na tumepewa the correlation the A to C, so zinalilete hivyo. I'll be having 2 times A is 0.5 weight of A, weight of C. Sasa si lazima niangalie weight of C. Weight of C iko nayo wapi? A is 0.24 times correlation which is 0.76. Here we are A to C times standard deviation of A, which was 9.34, times standard deviation of C, which is 12.31 plus ya mwisho sasa not clear. JM would advise you leave the meeting and then join again. JM kindly leave the meeting and then join again. Hiyo tumepata hapo. Then kuna hii ingine times sasa hii ya CB relationship yake ya CB. So weight of C weight of BBOE 0.26 and C weight of C 0.24 times correlation 12.31 times standard deviation of B, 15.1. But hiyo itakupatia tu time. Itakupatia tu time. You just work on it. Itahitaji tu accuracy and you get it correct. Accuracy. Nani amemalizia? Nani amechapa? Hiyo sasa ni accuracy tu and you're done. Yes. Utakuwa umemalizia. Haya, alafu niambie before we move to the next part. The next part. The whole of that. Yeah. Whatever hii zote ziko kwa square root. So ni mrefu zaidi Ni mrefu zaidi. The whole, whatever you get this, you get square root of that. And that will be the answer. So that is it. 6 marks. Yes. Ni kidogo kwa hiyo Sasa mimi niliona ni kidogo sana kwa hiyo. Kidogo sana kwa hiyo. Kidogo sana kwa hiyo. So, financial management students, is it possible for you to give us time kidogo? Huyu Purity ni nani? Purity Musayi ni nani? Purity, concentrate. So financial management students, now I would like to give you some time to maybe have a cup of water as we now go to the next time, to the next thing. The next thing is now totally for advanced financial management. So maybe you can give a room to the others. Yeah, financial management wanaweza toka kidogo So just finish. Financial management tumemalizia. Financial management sisi tulisema tukianza. Yeah, people will get you guys, you are going to pass. I know that. I know you're going to pass. You're going to, all of you, the sacrifice that you people make, waking very early in the morning, you see, studying late at night, all the sacrifice, they cannot go unrewarded. It can never go unrewarded. It can never go unrewarded. So I think you're done. So sharp, sharp anatuambia 26, around 26, sharp anatuambia 26. Student ndio tunatoka ama FM wanatoka, alafu tubaki na AFM. Kindly tubaki na AFM sasa. Tubaki na AFM, and then those who have not joined, now please give them at least this. Alafu wenye tumefanya hiyo swali vizuri, kindly share the question with your colleagues, those who not join, or those that are also wanted to join, but the meeting will not allow them to join. So kindly share so that they don't feel left. They don't feel left behind. No other question. FM, Winter, kindly. FM, wacha tukue nayo kesho asubuhi sasa. Tomorrow morning, very early in the morning. Yes, very early in the morning. So, I want to share another question here. We look at two concepts. We just remind ourselves. We are reminding ourselves. These are things that we know. Okay. Sawa sawa. That is the question. That is the question. Kindly download it. Have it. Meet with you. Meet with you. As we have it together. It together. So this is just a mock that was done by the physical student. The mock that was done by the physical student. So we can maybe look at one or two questions here. Maybe look at one or two questions here. And maybe we can, there's question number 5 and question number 2. Question number 5B, iangalie, na question number 2, number 2C. 2C. Naona hizo maswali mbili nataka tu tujikumbushe something regarding them. Something regarding those two questions. Something regarding those two questions. Something which, yeah, this I've said, John, I've said that this was a mock done by a physical student. This was a mock done by physical RCM physical student. Those students who attend physical classes. Those students who attend physical classes. Those students who attend physical classes. I know some of you have taught you in the area of financial management. Some of you. Good. Why can't we look at question number 5 first? One question number 5. Check it of hand kidogo. Checking of hand kidogo. And I want to do 2 things. Allow me not to even mention the option. Somebody answer John. John, which year? Somebody share that paper. And John, you go direct. Question number 5. And since I don't want to scare you, I want us to just do 2 questions. I want us to do 2 questions there. Thank you so much, Max. Question number 5B. Are we all there? Question number 5B. Question 5B. That's what we are doing. We just remind ourselves. 5B. We are reminding ourselves. How do we shake our hands? When it comes to the money market. Okay. So the question reads, Copper Limited, a United Kingdom firm, sold goods on credit to Belfast Limited, a firm in the United States of America, USA. This firm expects to receive United States dollar 365,000. Thank you. In 6 months' time from now, the firm is considering various choices in order to hedge the transaction exposure and has corrected the following data. So the data is given here. Exchange rates are provided. So we have a spot rate USD into Kenya into UK, USD into UK, and then 6 months forward rate given USD into UK as well. The money market annual rates are as follows. We have United States dollar and sterling pound. Foreign currency option prices in cents per sterling pound for the contract size of dollar. This is euro or sterling pound of 12,500 in 6 months as follows. So we've been told USD 1.7 is equivalent to 1 UK. That is call option and put option. You're told you're required to do what? Using appropriate computation, advise Copper Limited on the most suitable hedging strategy use among the following. So today, I want us to do the forward market hedge, and we do the money market hedge. Forward market hedge and money market. Forward market and money market. Forward market and money market. All right. If you find such a question, there are just 3 things that you need to remember. The first thing is what are you dealing with? Right? What are you dealing with? Who is the home country? Who is the home country? Because we have to analyze that. Who is the foreign country? Like in our case here, who is the home country? Operated is the United Kingdom, is the UK. Home country is UK. Lazima hiyo uelewe hivyo. And then this is the foreign country, USA. And then money in question. Money in question. Yes. Money in question. Thank you. Money in question. Is it a receivable or a payable? Is it a receivable or a payable? In our case, I've read somewhere that this person is expecting to receive. This is a receivable, right? We're dealing with a receivable. So money in question, in our case here, is a receivable. And when it becomes a receivable, if I'm preparing, or if I want to look at the hedge, the money market hedge, I'm going to draw a certain table. I know you understand the table. And at that point, we say that if it's a receivable, bank will always do what? Buy. Bank will always buy. Bank will always buy. Bank will always buy. If it is a receivable, bank will always buy. So we shall be looking at the buy rate. Here, buy rate. So it becomes easy for us now to compute the forward market hedge. Forward market hedge. Number 1, forward market hedge. The forward market hedge. Information about the forward market imepeanwa pale vizuri. Information about the forward market it has been given clearly. It is a 6-month forward rate, and the amount is given USD into UK. Now I want somebody to just tell me here. I want somebody to tell me if I'm dealing with the USD into UK, which currency represent my buy? Which rate represent the buy? Take your right hand, right? You shake it towards the home country. And when you are shaking, make sure that you don't do what? 𝒓𝒐𝒄𝒆𝒆. Right. Home country go USD into UK. So you shake 1.56. Hey, kuna watu bado wanapatia vitu tofauti. Kuna watu wanapatia kitu tofauti. Kuna watu wanapatia ati 57. 57. Unaangalia the 6 month forward contract. 6 month forward contract. Hapo ndio unaangalia. So it is true to say that 1.56 is the 1.5625 USD is equivalent to 1 UK. What about the 306? In fact, the amount in question was 365,000. 365,000. So we just multiply, and we get it 1 times 365,000 divided by 1.56. Pata ngapi? Unapata ngapi? 233,600 euro. 33,600. Hiyo haina shida. We now go to the money market. Money market. Now go to the money market. Now go to the money market. Now go to the money market. For the money market, we come up with a table. We come up with a table. And from what you have run, where should you hide? 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 Where should you hide your receivable? Is it in the left leg or the right leg? Where should we hide our receivable? Can I hide wapi? Our receivable? Can I hide wapi? Our receivable? Niko na left leg and niko na right leg. Where should I hide? Left, 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 left. So I have a borrow here, borrowing. I have a investment. So I'm going to hide my money here because it's a receivable. If it was a payable, we hide it here. If it was a payable, we hide it about right. It was a payable, we hide it. And it is always paramount to put the currency here. This is USD. So whatever that I'm dealing with here should be in USD. Before I pass it over the spot rate. Immediately you pass it over the spot rate, that is where the currency changed. The currency changed. If you not pass it to the spot rate, the currency remains. So I expect that after I change, because I'm going to change with the rate here, amount that I'll get here, it will still be in USD. It will still be in USD. Are we together? Are we together? Amount that will be there, it will still be in USD. Now, nataka twende tuangalie the rates. The rates. Rates ziko pale. The money market annual rates are as follows. Somebody to share the question. Somebody is requesting. The money market annual rates are as follows. United States dollar. United States dollar. Kindly. Nikiwa hii side, if I'm at this side, right? If I'm at this side, I'm not even going to look at the euro currency. I'm looking at the USD. And it is our USD here, nikiangalia vizuri, United States, we're dealing with the borrowing. The percentage that we are going to use, is it 12 or 9? Is it 12 or 9? Kuna mtu ananipatia 14. 14 hiyo bado, hatujafika huko hiyo side. Tuna deal na USD kwanza. And it will be on the borrow side 12%. And it is a 6-month contract. Don't forget. Most students forget the contract inaenda kwa muda gani. It is a 6-month contract. And going up, we say that we divide. Going down, we multiply. That's something that you need to know. Going up, you divide. Going down, you multiply. So when we have 6/12 times 12%, plus 1. Itakuwa ngapi? Yeah, it's 12. John, thank you so much. Asante. So how much shall we have here? The rate to exchange here kwanza 1.06. Asante. So going up, you divide. So you just take 365 divided by 1.06, we get a value here. And that value, it is in form of USD. Alafu tupitishe kwa spot rate. Spot rate ikumbuke kwamba ni current rate, the current rate. Wewe Mario, tafadhali. Bora ni sawa. Si tuko kwa foreign already. Uko sawa. USA ni foreign country. Yes. Mario, according to your interpretation, uko sawa. So nipatie hii tafadhali. 365,000 divided by this, we get a figure there. Mwenye alikuwa na share swali bado amesahau. Mwenye alikuwa na share swali tafadhali. Yes, home currency UK. Yes, home currency UK. 334, thank you, 340, 340, and still that is USD. The exchange is being done using the currency of what? The rate of USA. And then we pass these on to the spot rate. Now we need to look at the spot rate. Spot rate naona pale, angalia where we have the foreign exchange rates are provided. Spot rate USD to UK, 344. Is 344? 344. People are correcting me here. This is 344. Asante. 344. Sasa tunataka kuipitisha kwa spot rate. Spot rate sasa kuipitisha sasa ndio tunaenda home country euro sasa in euro form. Thank you so much. If I look at my spot rate, I have USD into UK. Can you tell me the amount of spot rate that we are going to use? The rate of spot rate that we are going to use. Still for the home country, right? The bank buys. Hapo ndio unatingiza mkono. Home country. 1.5773. 1.5773. And it is good to say it is USD to UK. So that when I'm exchanging, sasa how is USD and not either every so 1.5773 USD into UK. How do we change that? Can you change for me this to UK? Change for me to UK. Change for me that to UK. Itakuwa na 1.5773 USD is equivalent to 1 UK. 1.5773 USD equivalent to 1 UK. What about 344? 340 USD. So it's close multiply like that. 340 times 1 divided by 1.5773. Napata ngapi? How much? 218,310 euro. So here sasa thank you so much. 218,310 euro. Sasa tushavuka the other side. Now we're looking at a rate and investing, and that is the whole country. So the rate here, I can see sterling pound. Tell me, are we going to use 14 or 11%? Are we going to use 14 or 11%? Are we going to use 14 or 11%? Hapo ndio tuko sasa. 14 or 11? Yeah. In fact, now I can see we are together. So it will be 6 over 12 times 11% plus 1. Unapata ngapi? How much to get? 1.05. Na tumesema moving down, you multiply. So you take this one times this. So it will be 218, 310 times 1.055. Unapata ngapi? Mario, I'm happy that Mario is now able to get that. What's the total? Going down, multiply. And then nitakukumbusha vile unafaa kufanya ikiwa paiable. So what is the total? 218. It is 230,317. So 230,317. 230,317. This is the amount receivable in euro. Listen here and listen carefully. We are dealing with the receivable. The receivable, we expect to receive more. If it's a receivable, we need to receive more. Hakuna mtu ataki mingi, right? If it's a payable, ikiwa kidogo, the better for us. So if it's a receivable, which is the best technique? If you look at the money market and our hedge the forward market, money market, and the forward market. Which is the best technique, hedging technique for this? Which is the best hedging technique? It is the forward market. 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 Yes, the high. If it's a receivable, you want to receive the high. If it's a payable, you want to pay the lowest. Now I want to just show you if it was a payable. If it was a payable. The rule changed kidogo. If it's a payable, what happened to the bank? What does the bank do? What does the bank do? The bank said, so you're doing a change, right? Right? You're doing a change. The only thing that I don't want you to do is to start changing. To change the confuser. But at the back of your mind, know that if it's a payable, we hide it here on the right side of the table, right leg of the table, right leg of the table, right? Payable, you hide it here. And then you start your journey from here, right? You start your journey from here. So that means when going up, what do we do? What do we do? When going up, what do we do? You divide, you divide. When going this way, of course, portrait happen. When passing it through, pass over, you pass it over spot. And you must now look at the cell, the bank cell. So what hapa, unaangalia cell side gani, cell into gani. Alafu una pass over spot rate. Alafu kukuja hivi, you multiply. Of course, using that, the rate given under that. The rate given under that. The rate given under that. This class was supposed to end at 2:30. It was supposed to end at 2:30. And there's another question that I wanted us to go. Yes, it is almost good. Good. Or currency option. That one, if I do it now, all of you will go. All of you will go. All of you will go. I don't want to scare you. I don't want. Tafadhali. Let us stop at that point. Let us stop at that point. So pick it up. Just pick it up. Pick that up. Nataka tufanye hamadas kidogo tulikumbusha hamadas kidogo. Hamadas model kidogo. Hamadas model kidogo. Na sha what? Sha is a good friend. Aya, nataka tu chape question number 2C. 2C, Hamadas model kidogo, and then we call it a day. Hamadas model, then we call it a day. Hamadas model, then we call it a day. Question number 2C. It says that JAM Limited is considering undertaking a financial construction during which it would purchase its outstanding ordinary share using debt. This will raise the debt to equity ratio 1.8. 1.8. The following information was available for the company. We have existing debt to equity ratio, which is 1.2. Okay, that is before reconstruction. Then we have the asset beta of 0.6. The risk-free rate of return 6%. The return of the market portfolio is 12%. Debt finance is considered to be risk-free. And then we have the corporate tax rate of 30%. Somebody will share the question. There are those people who just joined. What are you required to do? You're required to get the firm's levered equity beta before and after reconstruction. The firm levered equity beta before and after reconstruction. Asante Max. Asante. With the pass, find you. Okay. To get the equity beta. To get the equity beta, we have to remind ourselves on the formula of Hamada's Bell. The firm's levered equity beta before and after financial reconstruction. So in this case, we have to remember Bell. How do we get Bell? Bell is given by Bell. But I've seen somebody giving us this. Bell multiplied by 1 plus D over T, and then you adjust that for tax. Just that for tax. That is Bell, beta equity of the levered firm. Beta equity of the levered firm. Right? Now, in our question, can you identify for me Bell? What is our Bell? Somebody. What is our Bell? In our question, what is our Bell? Beta equity of unlevered firm. Yes. Look at what we have there. There are some people who are giving us something which is not okay. You cannot give me the debt to equity ratio. You cannot give me the debt to equity ratio. We've been given 0.6 there. So you just apply that and you say that it is equal to 0.6. 1 plus 1.2 times 0.7. So how much shall we get? Give me now the figure. Hiyo tumemalizia ya kwanza. Before reconstruction. Then after reconstruction, our beta to equity ratio changed to 1.8. So people are getting 1.0, 1.104. Asante. And then this is before. Now after reconstruction. After reconstruction, still the formula applied, and our Bell remain the same. 1 plus 1.8. You see, our debt to equity ratio changed to 1.8 times 0.7. Are you able to see where I'm getting 0.7? 1 minus 0.3. The tax rate was 30%. So how much is this? But that is the asset beta, or we use it as Bell. Yes, it is that one. That is the beta equity of who? Unlevered firm. The firm without debt. 1.356. 1.356. Wow. What else do they need? Hiyo tushamalizana naye. What else do they need? After reconstruction, tumemaliza pia. Cost of equity using CAPM. Hiyo ndio tunaitaka nini? CAL. You remember? CAL before and after. CAL. The CAL using CAPM. When we're using CAPM, risk-free plus expected return on the market minus risk-free, and then you multiply by beta. Bell. Of course, this is before reconstruction. Itakuwa risk-free ni ngapi? What is our risk-free? Tumepewa risk-free. How much? 6%. So you can use 6 plus expected return umetupatia 12 minus 6. And then mbele yake ya kwanza before reconstruction is 1.14. Haya, unapata ngapi? Hiyo ni ya before reconstruction. Then mbele ya after reconstruction. 12.62 minus 12. Tutaweka percentage sawa. Tutaweka hivyo sawa. Then after reconstruction. Haya, hii inaleta kwa 6 plus 12 minus 6. Whatever that is changing is Bell. 1.356. Napata ngapi? How much are we getting? It will change in hiyo peke yake. our bell. How much? 14.1. What else do they want us to get? What else do they want us to get? The WACC, WACC, WACC. And we all know how to get WACC. We all know how to get WACC. Weighted average cost of capital. Weighted average cost of capital is given by weight of equity, cost of equity, plus weight of debt, cost of debt, like that, adjust the tax. When debt, you adjust for tax. Under Hamada's model, we adjust tax, right? We adjust tax. So we have the weight of equity. Now this is before reconstruction. Before reconstruction, and we shall be able to look at after. Well, do we multiply tax before adding one or after adding? He's asking a very good question. Yeah, it's before. Good. Weight of equity. We're going to get weight of equity. Before reconstruction, our debt to equity ratio is ngapi? Before reconstruction, our debt to equity ratio was 1.2. 1.2. Debt to equity ratio was 1.2. 1.2. Sasa ukishapewa hivyo, to get the weight of equity, weight of debt, you pick this ratio. You put it as a fraction. So 1.2 is equivalent to 12/10. True or false? True or false? True or false? You just state F or T. True or false? Good. And then you can simplify by 2, or maybe by 2, 6, by 2, 5. So I'll be having now debt to equity ratio of 6/5. 6/5. That means debt will be given by what is here. Debt will be given by that, and equity will be given by this. So the total of these is 6 plus 5. That is the whole, which is 11. So what is the proportion of debt? The weight of debt is equal to 6/11, which you get there. And then the weight of equity is equal to 5/11. Yes, sir. And particularly your debt. Your debt will come into 2 days for presses. 2 days for presses. 2 days for presses. 0.55. And the other one 0.45. At the end of the day, it should be 100%. Now at least I can get my WACC before reconstruction. So WACC given by I have the weight of equity 0.45 times cost of equity. L before was this one 12.62 plus 0.55 times I have the other one KD. Now we have not been given KD. What do we do? And you guys plant this. What do you do? If you're not given KD, what do we do? We use the risk-free rate. So we use 6%, 6% and 0.7 and 0.7. What are you getting? I want to give you assignment for getting the WACC after reconstruction. What are you getting as the final answer? Naona marks ananipatia 8%. I may go and attempt the other one, WACC after reconstruction. But it will be a disservice if I don't tell you that for the forthcoming exam, kindly note that it is not good to leave a blank space. Even if the theory is tough for you, please try and answer. Try and evolve, allow that question, any knowledge you put down there. Then make sure that you label your questions very well. Let me show you something here. Make sure that you label your questions very well, and your work should be very clean, very okay. Now, examiner tells you that you should include or you should indicate the question the way you've done inside your paper. So question 1, 2, 3, 4, and 5. Question 1, 2, 3, 4, and 5. Before you start doing that paper, kindly you do what? You first of all do the analysis. The first 10 minutes is not to start doing that paper, is to do the analysis, whereby you'll be able to see question 1A, you have a theory that you can get something. Like those points at the back of your answer booklet. B, you look at what it says, and then you have some points below the back at the back of your answer booklet, and then say that for this question I can get 11 marks. Then you go to question number 2, analyze it. I can get 18 marks. You go to question number 3, I can get 19. Question number 4, I can get 12. I can get 9. After you do your analysis, kindly start with a question that you're comfortable with. A question that you get more marks. A question that you can get more marks. That is question number 3. The mistake that people make is when labeling the question that they have done. The mistake that people make is just through labeling the question. Unaona huyo ameanza na question 3, and then when it comes to labeling at the top of the cover page, put 1. Until the question amefanya number 1. When the examiner or the person who is marking your paper get it, then you know what they do? They just look here. Umewaambia question number 1 ndio umefanya hapo ndani. Lakini according to question yenye umefanya ni question number 3. Atachukua tu answer za question 1. Kumbuka ana mark papers mingi. Atachukua answer za question 1 ndio umemwambia ndio hapo. A mark nazo question number 3. Sasa, who is to blame? Is it you or the person who is marking? Who is to blame? And umeambia tu vizuri indicate. Who is to blame? Who is to blame? And then, leto bana aje sasa. Ujue ana mark vitu mingi. Na analipo kulingana na amemark ngapi. Na wingi. Unaona? So, what I'm trying to say, can you make the work of that person who is marking your paper make the work of that person who is marking your paper easy? Let it be easy for the person to mark. Be very keen, right? So, umeanza na question number 3 for your best question, lakini hapo umelebo vibaya, so that means that question is your best and you get 0. Your best, you get 0. Lakini wakati unatoka kwa hiyo exam room, unatoka ukisimama unasema, hiyo kitu nimehiti vizuri. Hiyo kitu imekuwa sawa. Hiyo kitu, you see? That one you should avoid. You should avoid. Should avoid. Should avoid. Should avoid. Should avoid. All right. So you label it very well. Now you can have 3. Then follow the other one, which is 2. Follow the other one, which is 4. And then 1. Uzuri ni atiata, you're not limited to. You can start with any question. That's the best part with 𝒕𝒂𝒓. Nakwambia ati lazima uanze na question 1. Ikikuwa mawe, mambo inakuwa ngumu sana. Haya, sawa. That marks the end of our today's session. It's quite a pressure hosting you today. My name is CPA Stephen. I've been teaching early morning financial reporting and financial management, and physical school. I teach financial management and advanced financial management. Physical school. Ndio maana tutapatana na nyinyi watu wa online advanced. But you have great teachers, CPA David and Dr. Aura, and all of you are going to pass. All of you, I'm sure you're going to pass. The only thing that you need is to be confident. Be confident and have courage. Right? Oh, purity. Okay. Great. My name is CPA Stephen Max. My name is CPA Stephen. So if you want to do the currency, the part C, Roman 3 of the money market, You do it, you can share. We can always do what? We can always help you. We can always help you. That's all. Thank you so much. May you all have a blessed what? A blessed afternoon. A blessed afternoon. Yes, that's the faith. That's the thing. Yes, BDA. Yes, BDA. Tunataka all of you now, you do the BDA. You do the BDA. You do the BDA. Right. Great. I can see great people here. Those that I taught in intermediate level, the intermediate level. Asanteni sana na mkuwe na siku njema. Kuwe na siku njema. Wewe Judy. Goodbye. See you next time. See you next time. Looking forward to interacting another day.